Pranav Rao from Smartkarma, and I'm delighted to have with me today Rikki Malik, an Insight Provider on Smartkarma, to discuss his positive view on Chinese banks. Rikki, thanks for your time today on the 24th of June. In your insight, you flagged there are several positives surrounding Chinese banks that are underappreciated. What are these positives?
Okay, thanks, Pranav. Thanks for this opportunity. I think I'd like to start really with the negatives because that's what's very much portrayed in the narrative, the media, the research about all the bad things about Chinese banks, and then why that's not necessarily correct. So if I look at the three main issues that people think about in Chinese banks, it's the property crisis, bad debts, it's low interest rates and a net interest margin squeeze, and then because of all of that, the possibility of recapitalisation, dividend cuts, etc. Now, the way I look at it is that's all very well known in the market. And that's why the banks are trading at 0.5 times book. The property market has been going down for 4 years now. Because of COVID, because of China was locked down for so long, people haven't realized that actually we're very much through that process. So do I think property is going to go back to the races? No, but the declines are stopping. So if you look at tier one cities, overall the declines are narrowing. In tier one cities, the prices are now stable. So that's a very big deal, which means less provisioning needed going forward for the banks. So we've been through the worst.
Mm-hmm.
Some news in June, which was actually very positive for the property market, but because obviously everyone's focused on tariffs, etc., it's sort of gone under the radar, at least from what I can tell, is some changes in the Hukou system. So as people may or may not know, it's the household registration system in China. If you're born in a small town and then you move to the city, you are still registered in that small town. So you do not have access to medical, social security, unemployment, all of these things. So you can live there and work there for 20 or 30 years, pay your taxes, but still not be able to retire there because you can't afford it. Now, they've made some small changes in smaller cities over the last 1 or 2 years, but in June they've come out and said, now you have access to all those benefits, even if your registration is back in your hometown. So this is, I think, a very big unappreciated point, which now means that you've been living there 30 years. You couldn't afford to retire there, because you wouldn't have the benefits. Now you will feel comfortable buying a property because you will have all the benefits as I just mentioned. That I think is a good thing. And again, I'm not saying property is going to go up a lot, but the stopping the decline is what's key. Secondly, net interest margins. Now, yes, this again is something which we can see, we believe, has bottomed. If you look at the recent, on May the 7th, there was a big press announcement, a press conference by Ministry of Finance, PBOC, etc. They did a couple of things. They reduced the reserve ratios, required reserve ratios by 50 basis points. This frees up money for lending. But secondly, they reduced lending rates, which was seen as widely seen as negative for the banks. But actually, they reduced deposit rates even more. So over time, as time deposits roll off into the next one, investment banking net interest margins are going to rise. So again, the bad debt has bottomed, net interest margins have bottomed. It can really go up from here. In terms of recapitalisation, we've already had that announcement. Whatever banks are going to be recapitalised, it's out there, it's been done. That's not going to happen going forward. Dividend cuts, as has been, I don't know how much it's been publicized, but China's very trying to create this shareholder-friendly movement to encourage people go into the stock market. Part of that for SOEs has been to introduce interim dividends as well as final dividends, so that the prices are steady over time. They're trying to create a longer-term bull market versus a boom and bust cycle, which we've had generally in Chinese equities. You have big move up, big move down, and generally retail don't do well out of that sort of environment. They're trying to propagate, in our opinion, a slow, steady bull market, which is why the banks have been pushed, and they all are now doing interim dividends. We don't believe dividends are going to be cut. Their payout ratios are very low at 30%. So just from what I see now, the worst is over. Even if things don't get better in the near term, they are paying between 6 or 7% dividend yields. They're on half times book and maybe 9 to 10% ROE. Okay, that's the situation where we are. They are very popular in southbound. So even during the post DeepSeek tech rally in Q1, banks were still within the top 10 bought stocks in the southbound connect. That's continuing as we daily, because they 5-6% dividend yields. They know it's supported by the authorities, and if your deposit is earning 1% and you can get 5-6% in a bank where you think the downside is limited, why wouldn't you do that? Secondly, because as I've said, Beijing is trying to propagate this bull market in equities. They're pushing institutions to buy more stocks in Hong Kong. Banks are very popular also because A, the dividend yield, but B, because for insurance companies, it's considered any changes in value for an insurance company for a high yielding stock like a bank does not go through the P&L. It goes through other comprehensive income. So the general swings in the price won't affect their earnings, but they still get a 5-6% yield, which they, for an insurance company which has to pay out, again, very low interest rates, it's a very attractive investment. So overall, we first flagged Chinese banks back in March for our first piece on this. And then we revisited it just recently in June because of these changes I've just mentioned. From March to June, the banks were up about, the basket I suggested was up 12% versus the Hang Seng Index 2%. So, decent performance, 10% outperformance over 3 months. We think that has further to run for the reasons I've just said, in terms of we don't believe this is really appreciated in the market. And we think two things can happen. The market can continue just treading along here, but because of the yields and the support and the valuations, they will still perform. Or if the economy starts to pick up more, banks are a natural play on economic growth. So we think there's quite a good upside potential either way.
Thanks for that, Rikki.
Sorry, that was a very long answer to your question.
That's all right. That was helpful. As of today, Rikki, which Hong Kong traded Chinese banks stand out and versus their peers, and why, either positively or negatively?
Okay, I think if I had to buy two let's say two banks now, one SOE, one private sort of joint stockholder, I'd probably look at China Construction Bank. Now this is because, as I mentioned, southbound's been a big buyer. Most of the other banks have about 35 to 40% ownership, 8 shares, by southbound connect. China Construction Bank, this is more of a technical reason, China Construction Bank has about 13-14% ownership. Now it is estimated to have an earnings decline this year, and hence, from my perspective, the negatives are already priced in. So you have a very cheap bank with low expectations, high dividend yield, with a lot of potential buying in there. So that's for the SOE side. That's what I would look at that one. For the sort of smaller private banks, not private because they're all eventually sort of state-owned, but they're called, I think, joint stock banks is the correct term. We like CITIC and China Merchants Bank. CITIC has done very well, and their loan to deposit ratio is quite high. So for the ability for them to grow more is relatively limited. So if I had to choose between one of them, it would be China Merchants Bank. It's a very well-run bank. It's focused more on the consumer. About 55% of its loan book is consumer related. And that has been a reason why it hasn't performed as well as the other banks. Now, I think that's what's going to change. It has a relatively low loan deposit ratio, so it has the ability to grow its business, and its fee income is increasing, and its wealth management business is increasing. So I think those are the two I would focus on now from the long side. And the other ones, I'm not negative on them because they are still extremely cheap. So I wouldn't want to be short any of the banks in this environment. So that's what I'm thinking at the moment.
Got it. Let's kind of change tack here. What kind of beyond China's macroeconomic situation, as you've kind of outlined it, stands out to you as a risk that's perhaps underappreciated on the negative side with regards to looking at Chinese banks at the moment?
the risk is national service lending. Okay, so the banks get pushed to lend to industries because the government wants to push them wants to create that industry. So there'll be low margins or bad debts, etc. Now, of course, there is an element of that, and it's just why the Chinese banks are always, traded relatively cheaply. But over the last 3 to 4 years, most of the lending has been directed towards industries where Chinese are now leaders. So whether it's EVs or the solar industry, new high-tech manufacturing, which is where China's trying to push it away from, plastics, toys, etc., which was the old China. So that is a risk that is still there, that there is going to be an element of pushing people into unprofitable industries. EV is actually one example of that, because there will effectively be 3 or 4 winners in that industry, but there's probably 150, 200 companies in China, each province having its own 1 or 2 national champions. The banks I'm looking at would not be pushed in that direction. It would be the smaller banks in those regions. So, but that would be a potential risk out there.
Got it.
And the tariffs obviously are an issue, but what has been maybe not as widely known is that the export direction of China has moved very much away from the US. So it's a much smaller percentage now, and they're trading with South America, Middle East, Europe, etc. So again, nothing is risk-free, but I think a lot of the risks are overblown.
Got it. Well, thanks for all of that context on Chinese banks, Rikki. And listeners, check out Rikki's coverage of Chinese banks on the platform, and you do tune into our next Smart Call. Thank you.
Great. Thanks. Bye.